What happens to a rubber band when it's stretched to the max? It either breaks or it snaps back. In this video, I'm going to talk about the Home Affordability Index. It's been stretched to the max. It's crushing the housing market. And will it snap or will it bounce back? Hello, my name's Tyler Ford, Tucson, Arizona with eXp Realty, and welcome to this episode of Living in Tucson, your Tucson Real Estate Connection. And in this episode, I'm going to go over the Affordability Index. It's been stretched to the max. It's crushing buyers, and buyer demand is dramatically drying up, slowing down this housing market. And it's an index that definitely needs to be paid attention to. And for me, it's a red light, green light. If numbers are below a certain level, it's red light, be caution, beware. If it's above a certain level, it's green light. There's a lot of buyers and it's a healthy market. So I'm going to explain the Affordability Index and what it means and what it looks like in the current market that we're in. Each and every month, the Tucson Association of Realtors puts out the Tucson Housing Market Report. And within the report is the Housing Affordability Index. And it's something to pay attention to because we're now in a place where home buyer demand is drying up, and it has everything to do with affordability. There's people that do want to buy homes, but they can't afford it based on the median home price due to interest rates, the median home price, and the income that they make in order to be able to qualify from a debt to income ratio. So I'm going to explain this, and then I'm going to take you over to an Excel spreadsheet to make better sense out of it. But first off, just want to define the definition that they use to define it. Isn't all that great in my opinion, and I'm going to hopefully try to make some sense out of it. But it says this index measures housing affordability for the region. For example, an index of 120 means the median household income is 120% of what is necessary to qualify for the median price based on the prevailing interest rates. The higher the number means greater affordability. So this is an inverse relationship. In 2008, when the market melted down, there was a huge supply of inventory, low interest rates, home affordability became a lot more affordable. And in this area right here, homes were super affordable, and we've been on a decline ever since. And in the last couple of years, right in this area right here, home affordability ever since COVID hit has gotten super expensive. And it has everything to do with, first, home values, double-digit appreciation over the last couple years. And just recently, in the last year or so, the feds have been aggressively raising rates. It's been the most aggressive rate hike that we've seen in the history of the U.S. And so coupled with a median home price is as high as it's ever been, and interest rates being higher than they've ever been in the last 20 years, home affordability is now at a place where buyers are no longer able to afford this market. So this chart shows home affordability, and anything above 100 or above is green light. I call it red light, green light. So 100 and higher is homes are affordable. There's a big buyer's market pool out there, and buyers are able to qualify. 100 or less in terms of a number, to me, is red light, something that you want to be cautious about, because we're now in a territory where buyer demand is starting to dry up, and it is drying up, which will have a major impact on the market. So time will tell, but the buyer demand has dramatically dried up because buyers are no longer able to afford payments based on the debt to income ratio. Now I'm going to break down the numbers and hopefully make better sense of the Home Affordability Index and how the number is arrived at. So we're going to do two different scenarios. We're going to compare December 2020 to our current situation, September 2023. So I'm going to walk you through December 20 versus September of 2023. So back in December of 2020, the median home sales price was $250,000. And we're going to assume FHA 3.5% down. Back then, the interest rate was 2.65%, which would give you a monthly mortgage payment, PI, principal and interest payment of $952. And then if we add taxes and insurance, your total PITI, principal, interest, tax, and insurance, would have been $1,195. And did a little bit of research, and you use a median household income of $60,000, which would be $5,000 a month. And then if we subtract out taxes, the net monthly income somebody could use to qualify for a mortgage would be $3,750. And I'm in this scenario going to assume that we're just going to base the DTI only on the mortgage and not any other consumer debt or car payment. So based on this situation, the max, what we call DTI, the debt to income ratio, from an underwriting standpoint, you can go up to 45% of your income in relationship to your total debt, which would give you the ability to qualify for total payments up to $1,687. But the good news back then is you could qualify for $1,687, but the mortgage payment, the total mortgage payment, would have only been $1,195. So from an affordability standpoint, things were so much more affordable, and people, after they bought their home, weren't house poor because they had extra money, discretionary income that they could spend for other things. So again, back in 2020, things were so much more affordable and life was good for buyers. And if you look at the max buying power based on this situation, somebody could have afforded up to $360,000, although the median home price was only $245,000. So fast forwarding today, right now in the MLS, the median home sales price is $440,000. We're going to use some of the same assumptions. FHA 3.5% down. Today's interest, we're sitting at 7.5%. Your mortgage payment, principal and interest, PI, would be $2,968. And then if you add taxes and insurance, your total principal and interest, tax and insurance, total payment right now would be $3,325. We're going to bump up your income a little bit for inflation and say that your household income went up slightly. So total monthly income, $6,250 minus your taxes. Your net monthly income to qualify that you'd be able to use is $4,687. And if we take a look at your debt to income ratio based on the income, you can go up to 45% again. So the max that you could qualify for is mortgage payment and consumer debt of $2,190. But the problem is, and here's the big problem, this is what you could qualify for, and this is what the mortgage payment is. Therefore, housing affordability index is a lot lower. And here lies the problem. Buyers are getting crushed and being priced out of this market, and buyer demand is virtually disappearing based on home affordability. And in this situation, based on interest rates and income, the max that somebody could qualify for a loan amount is $215,000. So really the only way to solve this problem if you're a buyer is to be able to put a substantial down payment down to get your debt to income ratio in line in order to be able to afford to buy, which unfortunately a lot of buyers are not able to do. So again, you really want to pay attention to this affordability index, and anytime it's below 100, it's red light, be cautious. meaning things are getting affordable. If it's 100 or higher, that is a green light that things are affordable. There's a big buyer pool driving the market, and it's typically a much more healthy housing market. I hope you got value out of the affordability index and the explanation of it, and can better understand it. I know, to be honest with you, I've looked at it, I understood the basics of it, but until I put the Excel spreadsheet together and really dug into the numbers, did I completely get it. But right now, anything below 100, it means that buyers are being stretched. And we are dramatically below 100, which means buyer demand is virtually drying up. And for me, it's a warning signal, just to beware, proceed with caution. If we're above 100, it's more of a green light, that there's more buyer demand and buyers can afford homes. So again, it's something to pay attention to. If you're a buyer out there, I would encourage you just to be patient and stay put, because if you're strapped in terms of your debt to income ratio and you buy a home and you can afford the mortgage, the utilities and groceries, and that's it, life is no fun to be house poor and not be able to afford other things and also save money. It puts you in a bad position if you deplete your reserves and you don't have reserves to weather a storm. If you're a seller out there, I would encourage you to price your home correctly, look at the comps, and be aware that there is less buyer demand out there. So days on market are going to start to go up, and it could take a little bit longer to sell your house in the current market that we're in. So just pay attention to the affordability index. And again, if we're below 100, it's proceed with caution. Above 100, it means there's a lot more buyer demand. So hopefully this video helps explain it. Thanks for watching this video, and if you got value out of it, do me a huge favor, give me an internet high five by liking it. If you have any questions or comments about the affordability index or just Tucson real estate in general, go ahead and comment below. I'd love to connect with you and answer any questions. And for more awesome videos about living in Tucson, your Tucson Real Estate Connection, you can subscribe to the channel, hit that bell button, and each and every time a video comes out, you'll be notified. In the meantime, make it a great day. Buying or selling a home is one of the biggest decisions you'll ever make. That's why you need a local Tucson expert real estate partner. With all the exciting reasons you have for buying a home, one of the biggest reasons is it can dramatically increase your family's wealth. So whether you're looking to purchase your first home, your next home, a second home, an investment property, or maybe you want to sell your home, choosing an experienced real estate expert to help you will make it a smooth and easy process. And choosing the right realtor can make the difference of more money in your pocket after closing. So whether you're a first-time home buyer or a seasoned investor, or maybe just interested in knowing what your home's worth, contact Tyler Ford and team today. Call Tyler Ford and team today at 520-775-3400. That's 520-775-3400.